In this video, we're going to look at Coca Cola, ticker symbol KO, the pros and cons of the stock, what it could be worth if you invested 10 years ago, and hypothetically what it could be worth 10 years from now. Also, which financial institutions are buying and selling the stock, plus a look at the forecasted price targets from analysts, also any catalysts that could help boost the stock price. My name is Alex, and this is my Dividend Income channel. So let's start with the pros and cons. The pros, number one. Strong brand. Coca Cola is one of the most recognizable and valuable brands in the world. It has a strong global presence and enjoys high brand loyalty. Number two, stable and consistent performance. Coca Cola has a long history of delivering stable and consistent financial performance. It has a strong dividend track record and has been paying dividends for more than 125 consecutive years. Number three, diversified product portfolio. Coca Cola has a diversified product portfolio that includes soft drinks, juices, sports drinks, and bottled water. This diversity helps the company mitigate risks associated with changes in consumer preferences. Number four, growth opportunities. Coca Cola is continuously exploring new market and product categories. The company has also made strategic investments in emerging markets such as China and India, which offer significant growth opportunities. Cons. Number one, declining sales. The consumption of carbonated drinks has been declining in recent years, and Coca Cola has been experiencing the declining sales. The company is facing increased competition from healthier beverages and has struggled to adapt to changing consumer preferences. Number two, currency fluctuations. Coca Cola operates in more than 200 countries and is exposed to currency fluctuations. This can impact the company's financial performance and make it difficult to predict future earnings. Number three, health concerns. There is growing concern about the health effects of sugary drinks, and Coca Cola has been criticised by contributing to the obesity epidemic. This negative perception could impact the company's sales and brand image. Number four, dependency on bottlers. Coca Cola depends on a network of bottlers to manufacture and distribute its products. This can make it difficult to control product quality and consistency, and bottler disruptions can impact the company's sales and operations. Now let's have a look at how the stock has performed in the last few years. If you'd invested $10,000 in Coca Cola 10 years ago, what would it be worth today? $10,000 10 years ago on May 8th, 2013 would have bought you approximately 235 shares at the closing price of $42.46. Then as of May 8th, 2023, the value of your investment would have been approximately $15,044.70. Based on the closing price of $64.02, that is slightly over a 50% increase. This is assuming you have not reinvested the dividends, as this would be much higher. The current dividend pays 46 cents quarterly a share. From those 235 shares, you would be receiving $108.10 quarterly and $432.30 annually. Please note that this is an estimate based on historical data and does not take into account taxes or transaction costs that may have incurred. We cannot predict the future, but if we did hypothesize and make an informed decision, if we purchased 10,000 today, what would it be worth in 2033? At today's price of $64.02 a share, that would get you approximately 156 shares. This would give you $71.76 a quarter and $287.04 annually. If we assume hypothetically a growth of 5% per year over the next 10 years, that 10,000 investment would be worth approximately 17,000 in 2033, not accounting for any dividends that may be paid out during that period. If dividends were reinvested, it could potentially grow to 29,600. This calculation takes into account the compounding effect of reinvesting dividends over a 10-year period. Now let's have a look at what financial institutions have been buying and selling. Institutional investors own a combined 72.25% of Coca Cola. We can see a top 10 breakdown here. Fidelity Management and Wellington Management are the only two that have trimmed their stakes by a significant amount, both reducing by over 8%. All the rest have been buying up shares, altogether significantly more than have been sold, which is good to see if you already have shares in the company. Now, what do all the analysts think the 12-month forecast for the stock price could be? CNN Business have an average 12-month price target of $70. That is 9.3% upside from where we are today based on 20 experts. TipRanks has an average price target of $69.44. That's an 8.47% upside from where we are today based on 16. And Zacks have an average buy price of $70, 9.3% upside from where we are today based on 15 analysts. If these price targets come to fruition, we will see new highs from the stock price. If we zoom out over the last 40 years, we can see that progress has been slow. It plateaued for a number of years. What catalyst could help the stock price rise? There are several potential catalysts that could drive the stock price higher. Number one, strong financial performance. If Coca Cola continued to deliver strong financial performance, it could attract more investors and drive the stock price higher. This could be driven by factors such as revenue growth, higher profit margins, or successful cost-cutting measures. Number two, innovation and product diversification. Coca Cola is known for its iconic soft drink, but the company has been working to diversify its product portfolio in recent years. For example, the company has launched new drinks such as sparkling water, coffee and tea. If these new products are successful and contribute to revenue growth, it could drive the stock price higher. Number three, expansion into emerging markets. Coca Cola has a strong presence in many developed markets, but the company is also expanding into emerging markets such as India, China and Africa. If these markets continue to grow and contribute to Coca-Cola's revenue, it could drive the stock price higher. Number four, acquisitions and partnerships. Coca-Cola has a history of making strategic acquisitions. If the company makes successful acquisitions in the future, it could drive the stock price higher. And number five, environmental, social and governance, ESG initiatives. ESG factors are becoming increasingly important to investors, and Coca-Cola has made commitments to sustainability and social responsibility. If the company is successful in achieving ESG goals, it could attract more investors and drive the stock price higher. So is it worth buying? The dividend yield is currently 2.87%. It has a market cap of $276.86 billion and a payout ratio of 78%. The payout ratio is high because the company has a long history of paying consistent and increasing dividends to its shareholders, and it prioritizes paying dividends over retaining earnings for reinvestment in the business. Now, for some companies, this could be a worry. In the case of Coca-Cola, the company has a strong financial position and has consistently generated strong cash flows, which allows it to continue paying and increasing its dividend. The stock price had a 52-week high of $66.38 and a low of $54.02. I have an average buy price of $58. It makes up 13.24% of my portfolio, so this is not a priority at the moment. If I didn't own Coca-Cola stock, I personally would not buy in at this price, as I do think there are better opportunities. As a shareholder, I'm going to hold it as it is a solid dividend payer. There is a lot of volatility in the market at the moment, but Coca-Cola does not fluctuate in price by a huge amount. Over the last couple of years, it tends to trade within a $10 range of the mid-50s to mid-60s. Personally, I think a good buy-in price is the mid-50s. This is the low side of the last couple of years' fluctuation and provides a margin of safety. Thanks for watching. As usual, if you've enjoyed the video, please like and subscribe.